Hey everyone, welcome to the Plug and Play FinTech webinar on financial inclusion. The agenda for today, we will have a fireside chat with leaders in innovation from top global financial institutions. Then we will have presentations from 4 startups that contribute to the financial inclusion space. Let's get to housekeeping. During the webcast, if you're not speaking, please stay muted. Throughout the fireside chat and startup presentations, we'll be taking questions. So in the middle of your screen, down at the bottom, there is a Q&A box. Please use that and we'll respond throughout the event. Also, there will be a pop-up poll on each startup presentation. Please respond if you would like an intro. Now welcome, let's get started. So financial inclusion can be approached in various ways, but generally, it's offering products and services that allow everyone to have access to financial resources. The FDIC shows that 1 out of 4 US households remains underbanked. The impact of COVID-19 makes this issue of financial access more pressing, as millions have lost their jobs and need additional assistance, or for those that need digital access to their banking services, now more than ever. By implementing solutions that can help these customers understand and access financial resources, banks have an opportunity to not only help those who currently lack access, but to massively increase their customer bases. To continue this discussion, allow me to introduce you to our panel. Carol Grunberg, the VP of Money Management and Innovation at Northwestern Mutual, will be moderating the fireside chat. And our panel includes Ian Cox, the head of Synchrony Ventures, and Luis Hernandez Magro, the Director of Innovation at Banorte. Carol, I'll let you take it from here.
Great, thanks so much, Kizwana. And thanks everyone for joining us today. Super excited for the next 30 minutes. We've got a bunch of great questions teed up. We're hoping to have a great conversation, and please jump in and ask us any questions. I believe the chat is turned on. So before we get started though, why don't I turn it over to you, Ian and Luis, to maybe tell us a little bit more about yourselves. Luis?
Sure.
Or Ian?
Yeah. Hi, thank you for having me today. I'm Luis Hernandez Magro. I work for Banorte since 12 years ago, and I'm in the innovation department, mostly focused on risk projects, to try to bring innovation to risk areas.
Hi, my name is Ian Cox. Thanks for having me. This is really exciting. Currently, I lead Synchrony Ventures, which is the small corporate venture shop attached to Synchrony Financial, where we invest in Series A and B startups, primarily in fintech. Prior to this, I was in a similar role at BBVA and also had a stint at PayPal working for the Latin America team.
Great, thank you both very much. So a little bit about me. I am currently at Northwestern Mutual, as Juana mentioned, and you saw in the write-up, overseeing money movement, innovation. But I spent pretty much my entire career addressing the problem of how to provide people with equal access to resources and have true financial inclusion. Starting in a financial services startup I did a while ago, moving on to Google and spending quite a bit of time trying to tackle this problem there. Also doing it at Ant Financial right before Northwestern Mutual, and Ant is the largest mobile payment platform in the world, with 10 mobile wallets across Asia. And so this is definitely a global problem, as it's 1 in 4, as we know, 1 in 4 people in the US are underbanked, and especially with everything going on with the pandemic, it's just even more critical now to have the right, provide them the right tools and services to just make it financial inclusion more accessible and easier for a lot of people to attain. So with that being said, why don't we jump in? I'm going to hand this over just at a high level. Let's just frame up what does financial inclusion mean to both of you. So Ian, when you at Synchrony Ventures and you in general think about financial inclusion, how do you guys approach this and how would you describe it?
Sure. I mean, I think at its core, I think the belief that brings all of us to the panel is that finance can and should be a force for good. I think that's kind of the foundational element that we all believe. I think it's a combination of financial literacy and access. And those two things combined can allow people to access the type of financial solutions and products that can allow them to pull their dreams forward, pull their aspirations forward, or gain the stability of being in the financial mainstream, while also doing so with the right information, the right knowledge on how to manage those finances and make sure that they're doing so responsibly and in a way that will actually lead them to their goals. So, there's both parts kind of rely upon infrastructure, be it educational or financial, but the combination of those two together for me means financial inclusion.
That's great. Makes a lot of sense. Luis, how do you think about it, about Banorte?
Well, financial inclusion for Banorte and in Mexico is a big challenge. It has the target to get more people using financial services, especially people that has no proper access because of their physical location or because of their socioeconomical status. And financial inclusion can help these excluded segments to take advantage of many financial opportunities. When you get a bank account, a door gets open to a range of other financial services like credit facilities or credit cards or loans for housing, loans for studies. And I think that it is fair to say that financial inclusion promotes social inclusion, or maybe seen on the other side, financial exclusion can reinforce inequality and social exclusion. So this is very important. Now, the point for us in Banorte is that having a bank account is not enough for an inclusive financial system. We have many customers that have a bank account to receive their salaries or social aids, and they go every month to the ATM, withdraw everything, and forget about the bank for the rest of the month. These customers count for the financial inclusion statistics. However, they are not getting all the benefits that come with financial inclusion, with financial services. So this is one important point, that the opening a bank account for these customers is a big step, and for the bank is the starting point for a process of full financial inclusion, so they can really get all the benefits of financial services.
So you touched, Luis, a couple of times on the notion of that finance should be a force for good. Again, you mentioned it explicitly as social good as well. And so do you both believe that finance should have a responsibility to the social good, and how then, and if so, based on what you both said, I obviously that's, that would be yes in general, but if so, then how is it that you engage with your clients in such a way that is, you're ensuring that it's benefiting them, that it's clear that the benefit is really to them as opposed to the organization?
Yeah, well, it's a process.
Go ahead.
Yeah, go ahead.
Well, I was going to say yes, absolutely. So it is our responsibility. With the freedom that we've been given to take deposits and to issue loans comes that responsibility. You can't just take deposits off the street. That's what we've signed up for. And really the responsibility question is a challenging one, because you have to balance the equation between access and paternalism. And I think that's a bigger question than one that I can tackle. But at least my personal view is that access to credit and access to financial services should be low cost and as readily available as possible. And if complemented with robust financial education, which is tremendously hard to deliver, let's acknowledge that, it can have very positive outcomes. But you do need to be careful around those corner cases where people either misuse or misunderstand financial products. I think we all fear that. I don't know whose job it is to restrict that, and that's a challenging one.
Interesting. Luis, did you want to add anything on that point about the responsibility of finance to the social good?
Yes, well, banks play an important role as trusted custodian of deposits and also as credit grantors. And banks can lower some barriers and also help to overcome some others. So we have this responsibility to make an effort to flat the road for financial inclusion.
So Luis, I know you have a product, I think it's a product that's called Pepper, and that touches on this, on kind of the relationship, I think, with your clients. But can you expand on that a little bit and why this is an important solution for you?
Yes. Yeah, well, Pepper is an app of Banorte. It's a built-in house app, and it has it allows you to send and receive money without sharing your banking data. And the idea is that we have a bank app that is as easy to use as social media. So indeed, you can personalize your Pepper with your Facebook profile, and you can charge there your contacts and chat with them, and also send invites to download Pepper. And if you want to send money, the beneficiary can withdraw the money in an ATM with a digital card, or she can transfer to a bank account if she has one. But not only that, with Pepper, you can open bank accounts in 2 minutes. This is very easy. And also you can create groups to share the bill, or to organize this group savings pools. And in Mexico, we call them tandas. And also, you can receive remittances from the US. There is a subsidiary of Banorte, Uniteller, in the US, where you can send money to Mexico and other Latin American countries, also some countries in Asia. And with Pepper, you can receive the money there without going to these delivery points. Well, in this COVID time, it is very useful.
So that's really fascinating, Luis. When I was at ANT, we did a lot of this in regards to really cracking this cross-border payments across wallets and or through apps. And so it's really exciting to hear that with Pepper, you could do cross-border from the US into Mexico, Asia, and other parts of Latin America. So yeah, that's fantastic. Congrats. That's a really important problem to solve.
Thank you.
You guys are on it. That's great. What are you seeing in the space in regards to interesting potentially technologies and how they might differ in the different markets you guys play in? I think you're on mute, Ian.
Sorry about that. Yeah, I was double muted. Sorry about that. Synchrony is focused primarily or entirely in the US right now. And I think one of the things we learned early on as we went through digitalization and we were trying to provide our products through digital formats, and by the way, doing so effectively is a form of inclusion because sometimes people can't make it to the physical locations, was that the biggest primary barrier that we needed to overcome was identification. And ensuring that the person who was on the other side of the mobile phone or the mobile app was who they said they were. In the early days of kind of online finance, I think that was a major barrier to inclusion. People with large digital footprints were easier to verify. And those large digital footprints were largely correlated with socioeconomic status or with previous access. So early on, we invested in two great companies, Payphone, now called Prove, and Socure. And they're both industry leading in their ability to help validate identities through a digital onboarding flow through some really interesting machine learning applications. Now that question of digital identity is kind of the foundational one that allows people to access through a low-cost digital channel. And that's one that we're really excited about. We think we've come a long way. Now there are many others that are still incomplete. Identity may be solved, but you know, a challenge that faces all credit institutions and financial institutions is alternative underwriting. We generally try to predict people's creditworthiness based on their historical data and their historical payment patterns. That doesn't really work well if you don't have any. If you're thin file or no file, or even in the case of some Latin American countries, there's no credit bureaus or no positive credit bureaus. I know in Mexico there is one, but having no indication to the creditworthiness doesn't allow us to underwrite them in the way that we're used to. And that too creates friction in people's aspirations to get into the financial mainstream. So there are a lot of companies that are working on that problem right now, and that's one area that I'm personally very passionate about.
So let's expand on that a little bit in regards to using alternative underwriting methods. What sorts of things are you guys doing, Luis, in decisioning that might be alternative, gives you alternative signals into risk factors?
Yes, well, for credit can be a good product for financial inclusion, but there are some aspects to consider, like the product design. Here, maybe the main point is that the payment schedule should match the pattern of cash flows for the customer. And also, well, the risk assessment, I'm going to go there in a moment, but also delivery and collection aspects are very important, especially for rural areas where you can take advantage of intermediaries and collaterals. But the point of credit assessment, the risk assessment, is now really very exciting, as Ian mentioned, because we have alternative models that are really powerful. They are alternative in data. They also have alternative methodologies and also alternative approaches. Some of these models, maybe we can call them psychometric, are really indeed measuring how trustworthy the applicant is. So this is an approach to assess willingness to pay. So this is, yeah.
What kind of things do you look at though, Luis? Can you share a little bit?
About these scores?
Yeah, like what are some of the things that go into those scoring in regards to their willingness to pay, how creditworthy they are? I think you look at things that are maybe alternative risk factors. Do you mind sharing maybe a few things that you guys look at?
Yeah, sure. Well, these scores use social media data, but also there are scores that are based on questionnaires that you fulfill on the screen. And this is important, not only what you answer, but the way you answer, the way you move on the screen, if you go back to correct one question, etc. There are others that are very interesting based on pictures. The applicant is set with a set of pictures, and she has to select one, the one that best identifies with her, and then another set, and she picks one. And based on this, you have a kind of a score about your personality. So that there are several alternative approaches for this point.
That's great. Really interesting. And so Ian, you touched on this as well. You brought this up in regards to alternative risk lending risk signals that you guys look at. I think I haven't heard of doing the image thing is really interesting to try and like get some information about a person in regards to you know, which photos they use and to use that in underwriting. Are you seeing anything similar like that? Are you guys doing anything similar to that specifically?
I can comment on one thing I'd like to make clear is I'm kind of speaking in platitudes of my industry knowledge, not specific to Synchrony in any way.
Yeah.
My understanding of at least the U.S. financial lenders is like we'd be lucky to just be doing cash flow underwriting. Like that's actually a pretty novel idea, despite the fact that it's readily attainable. So most financial institutions in the United States are still underwriting based on FICO primarily. So a good first step, you know, before we get to pictures and before we get to, you know, advanced things might be to just do a plaid connection to your bank account and use some sort of AI just to look at people's cash flow over the last 24 months. That would work. That would be a very good start, particularly for thin file people who are debit card users. You know, if you're a debit card user, you may not have a credit history, but you may have very reliable income. Mm-hmm. And that picture would not be understood with, you know, traditional credit scores. So I think we have to crawl before we run or walk before we run rather. But the reality is the data is there. And the real challenge is the aggregation of the data, dealing with the privacy and compliance issues around the aggregation of that data and the storage of that data. And then there's just math. It's doing the math and understanding what risk you're taking on. But we're still kind of on the earlier part of that equation, I would say.
Yeah, I agree. I agree. It's interesting. I haven't, especially, you know, having worked so long in Asia, seeing some of the advancements that are coming out there and some of the creative ways in which underwriting takes place. So, and so it'll be interesting to see how much of that we are able, or how quickly to adopt some of those things as they parlay to, you know, markets outside of Asia. But it's, yeah, very interesting on the, you know, you guys, Luis, are doing this. It'd be interesting to follow and see kind of the outcomes of that in regards to using these alternative methods to underwrite. Let's talk about with this financial health. So we touched on this a couple minutes ago in kind of the overall notion that it is how important it is to really provide financial literacy, and from both a social good perspective, but also from a profitability perspective. So how do you assess a person's overall financial health?
That's a great question. It's a difficult one. Yeah. I don't think we've cracked it. But what I do think has been a push in the right direction has been the reframing of that conversation I've seen in the US over the last 3 years, which is 3 or 4 years ago, the term of art was financial literacy. That's how we referred to it. And we've evolved to now talk about financial health and even financial wellness. And what I think that denotes is a more comprehensive understanding of the issue. This is not about literacy per se, and literacy actually can be kind of a toxic word when you think about kind of the haves and the have-nots. Wellness means is around not just numbers on a spreadsheet. It's around utilizing your assets in the best way possible to achieve goals and to pull the future towards you. And I'd say that's a pretty comprehensive analysis. It doesn't just include your income and your savings, but it must include your goals, your aspirations, and the uniqueness of your family situation. And so wellness is a far more encompassing and ambitious scope to look at it. And I'm encouraged to see a lot of startups attacking the wellness issue very, very directly, where literacy, as we traditionally understand it, is but a subcomponent.
Yeah, Yeah, and at Northwestern Mutual, for example, from our vantage point, that's entirely what the company is focused on, right? With financial security for both currently, but then also, for our loved ones and leaving a legacy. So ensuring the right financial health today, financial security, but then obviously for your family and your loved ones also. So that holistic picture. And so, yeah, that is, I think, becoming more prevalent, particularly now with everything that's happening with the pandemic, and just how important it is to really have that right stability and financial security in times like that.
I agree.
Okay, so go ahead, Luis. It looks.
Yeah, about financial health, I think that's the soul of the full financial inclusion process. And it is not an automatic outcome of financial inclusion. We have to work actively on that. And for example, here in Mexico, the National Strategy for Financial Inclusion, launched May this year, includes some questions to try to start to evaluate financial health. And there are some data there, like countries with very high penetration rate, like 90% of the people is financially included, but 1 out of every 4 households reports difficulties at the end of the month. They are running out of money or to keep up with payments. So financial inclusion and financial health have to be work at the same time. So if we want to contribute to sustainable financial system.
So this is actually a perfect segue to a question that just came up in the chat. So the question is from Maxime: how do people balance using credit cards to build their credit score with the risk of being indebted? So again, what would be your thought? What are your thoughts on this?
I appreciate the question. It's absolutely the right question. Yeah. There are a lot of ways that as a financial institution we can help, but it's tricky, right? We'll set a credit limit, for instance. We'll say, based on the information we have on you, as imperfect as it is, we think this should be your maximum exposure. And we are not entirely afraid of people becoming indebted. That's actually kind of the purpose. Becoming indebted means you're pulling consumption forward and you're going to pay off over time. That's actually an okay behavior, as long as you're doing so in a sustainable way. And so I think this links back directly to the financial wellness picture, because the complexity of forecasting your own income and understanding how you will use it and what your future obligations were and whether or not you can afford becoming indebted is actually a complicated question. The math around it is difficult, and I am very optimistic that artificial intelligence and machine learning can help crystallize that and make that a much safer bet, if you will, because we just don't know what tomorrow brings us. But I think the analysis of the past and including other variables may allow people to take on that decision of being in debt, which, by the way, sounds very toxic, but is not necessarily toxic, and can do that with a lot of confidence. And confidence is what really is critical. Yeah.
Yeah. Well, I agree, and also there are some cultural barriers that, like in Mexico, for example, 40% of the people think that credit cards are only for emergencies. And a very high percentage of people with credit cards think that they should use them only with bills higher than 500 pesos. So they are not really using their credit cards in a consistent way. And when they have to use them, then it is sometimes they get struggle with doing payments. So I think this is a point of education. and getting a close contact with your customers can give you some insights of what they really need, think about the use of credit cards.
Yeah, because it's fascinating. It's an incredible financial instrument, and I think the implication is that, you know, there's such a high risk of as you know, as Maxime stated, being indebted, but revolving in essence on a credit card. And so there's so many different ways to use it, from, using it across all your transaction needs, and then transacting on it and not, holding a balance, but that takes a lot of discipline, and it takes really understanding how to use those tools. So
right.
Yeah, it's a really good question, because that is such an amazing financial instrument, obviously, to leverage. As you said earlier, Ian, right now, the most mainstream thing we have for underwriting is that credit score. And so that's essentially, for people starting out, that is really one of the only ways to start to build that credit rating, is on their transaction or revolving behavior on cards. So yeah, it's a good one. We have something similar also that popped up. So we've got, let me see how much time we've got. Looks we've got about 5 minutes. So why don't we do stick with some questions? And I'm not sure if we're able to do the questions live, guys, but I'm going to just take what I see in the Q&A. So Luis, this one's for you. How can unbanked individuals save and access cash in Mexico or improve their financial wellness?
Well, usually you need a bank account, and now it is very easy to get one. Banorte launched some bank accounts that have no minimum balance nor opening balance. As I said, you can open them in 2 minutes. And I think that's a good way to start saving money. In the past, there were some barriers about terms and conditions, but now I think it's easier to use bank accounts. And here the point is that some people don't trust banks or don't trust governments, so they are looking for other instruments to save money.
Great, thank you, Luis. So we have another one. What are some of the most critical ways fintech startups can help drive financial inclusion? And then second, are your companies considering to work with startups to solve some of these challenges? And what are the advantages?
So the answer to the second question is yes. That's fortunate, because that's why I have a job. So the answer is absolutely yes. And one of the advantages of working with startups, I mean, there's so many, but the ones that I always come back to are the nimbleness and the quickness to learn, to launch experiments, to prove out hypotheses, and to figure out if what they're building is actually resonating with the market. That's unfortunately a luxury that large incumbents lose over time. We become big ships, and it's hard to turn. And hand in hand with that, the thing I enjoy the most about working with startups is that they develop such in-depth and intuitive understanding of their target market. That's really, really fascinating, because they often are part of that target market. We joke around that at big institutions, we do research, startups do me-search. Because oftentimes it's a founder who's passionate about a problem because they lived it and they understood it. And that tactile and intuitive understanding of a financial product is so hard to replicate and so humbling as a large institution to learn about. So we spend a lot of time talking to startups. We invest in a select few. But it's not a bad time to be building a financial inclusion geared startup. I think that there's great tailwinds. There are a lot of smart investors out there trying to support them, and there are strategic investors like ourselves who are also very much committed to supporting technologies that can drive financial inclusion.
Great. I'm going to see, we've got a couple others. Let me touch quickly on what are some of the most critical ways the fintech startups can help drive financial inclusion. So we've touched on this, but I think it's also, this was something I think, Ian, that you mentioned. I think you said the word goals. And so one of the really interesting things is, technology is, very accessible, right, these days. And so many startups and companies are building around, the capabilities that using technology provides. But what is really important is having that insight into that client base and what is it that that client really needs. So we touched about the need in just to access a person's whole self to ensure that they're able to not only plan for today, but plan for tomorrow. So that's critical, especially right now for so many people as they're trying to just, grow their families or individually. So startups that are really focused on that, I think will have an advantage today and in the future. They'll make it more pertinent than the one use case. Okay, so let's go to the chat. Let's see. How do we mainstream? So Aaron's got a good question about how do we mainstream the conversation to a larger population to help them understand what it actually means outside of our own industry bubble in regards to financial health. So great question, Aaron. I think there are a lot of these conversations that are, I think, starting to emerge, right? And so I think it's continuing to have dialogues like this and continuing to raise awareness. But I think, holistic financial health, again, is becoming more and more significant and prominent in that industries outside of financial services are starting to understand. I mean, you would see this firsthand. What would you say to Aaron's, how would you address Aaron's question?
Erin and I have had this conversation before, so I'm glad she brought it up. And I'm a big fan of what she's building. I am a huge proponent of curation and verticalization in getting the word out. And what I mean by that is, on a daily basis, we are overwhelmed by the vast amounts of information that are available to us. And that's primarily through online channels. And a lot of it gets kind of muddied. You can't really make things through. And where I believe there's a huge opportunity is through kind of curation and having kind of, dare I say, financial influencers around who can really resonate with a specific audience and help you navigate that. In a sense, finding a member of that community who may know a little bit more and might be able to guide you to financial products that work for you because they work for that person as well. We need digital Sherpas. We need financial inclusion kind of Sherpas. And I think the kind of one-size-fits-all approach doesn't work. I think they have to be within communities, within verticals of people who face similar financial realities.
So to that, I'm pivoting over to a question for you, Ian, in the chat as well, or in the Q&A. What else does financial inclusion mean beyond bank accounts? So I think we touched on this a little bit, but besides savings and checking, what else does that mean? When we say it's a person's whole self and helping them attain their goals, do you want to expand on that, specifically what that means?
From a product perspective, in my mind, the bedrock of financial inclusion is developing a identity that can allow you to onboard yourself. So, in the U.S. still, illegal immigrants or people who have gotten here at different times in their life, like, the DACA people may not, have the ability to do that. So that's the bedrock of that. And that's not just for financial inclusion. That's, to Luis's point earlier, is to participate in society. A current account is a must. And then a savings account becomes almost a luxury, right? The savings account first is around emergency savings for unforeseen circumstances. It's aspirational if it can be a vehicle to accumulate wealth. The majority of Americans certainly don't have that financial standing. And then I'd say the third component, and it's similar to kind of savings, is also access to credit. Access to credit that is intuitive, that is present at the moment that you need to make a purchase, that is contextual, that is present in a checkout flow that's easy to understand, and that's responsible and non-toxic. I'd say that's the core of it. When you think about the broader financial picture, obviously goals are important, and and they are the kind of North Star that these financial tools are hoping to deliver.
That's great, thank you. I'm getting a prompt that we are just about time. I see we have one more question. So I'm hoping, Kizwana, that we're able to address the question maybe after this. We could maybe send a follow-up, but I do think we, let's maybe any final thoughts everyone wants to share, and then I think we need to get over to the startup presentations. So Luis, do you want to share a couple of final thoughts in regards to what organizations and startups should really focus on as it pertains to financial inclusion? What is your advice?
Yeah, well, we banks have an important role in this construction of the financial ecosystem, but banks are usually very heavy, and we don't move with the velocity we need. And so we can work with other agents like intermediaries or with fintechs and other vendors to have quicker responses to the market needs. So I think that this is the challenge of financial inclusion, that the challenge for a country where governments, policymakers, banks, startups, there are many agents that have to converge on this effort.
Great, thank you, Luis. And Ian?
I mean, I think the parting thought for me is that these conversations are critical and encouraging, and the level of the questions and the insights shared by Luis and by yourself, you know, these are the things that need to continuously happen, because these are difficult systemic problems. But the conviction in the North Star, I think we do agree that you know, the opportunity is there. I'm incredibly optimistic. I think the collaboration between incumbents and startups can really yield amazing things. So I'm looking forward to being part of it.
That's great. Thank you. And I would say my final thought on this is probably that to look at at a person's whole self. So again, financial services is no longer about savings and checking, but it's about what do people do with that money, and ensuring that they're able to easily grow it, access it, and then apply it towards their goals. So just thinking through the entire client. So again, thank you guys. This was really, really good doing this with you. It was fun, and thanks everyone for tuning in. Kizwana, I'll pass it over to you.
Thank you, my pleasure.
Thank you.
Thank you.
Thanks all. A virtual round of applause for our panel. That was truly insightful. So now on to our startup presentations. The startups that you will hear from today represent broadly the category of financial inclusion, how startups in the US and beyond are approaching this concept, like giving employees early access to cash, making the credit decision process more efficient in the UK, digitizing cash in Africa, and familiarizing the younger generation with finance as early as possible. You will see the various ways one can approach financial inclusion. Each startup will have 5 minutes to present, then there will be a 2-minute Q&A. If you're running out of time, I'll put on my camera as an indicator. So now to kick us off, we have Pay Active, allows employees early access to cash. Also our portfolio company that recently announced a $100 million raise.
Thank you, Kizwana. Hi everyone, I'm Safwan Shah, sitting in my office in a lockdown. So given I have 5 minutes, I'll quickly share my screen. Kizwana, would you share the screen or should I share? I don't have control.
You can share.
Okay. Okay, let's find it. No, I don't think I can. Okay, there we go. Can you see my screen?
All good.
Anyone? You can?
Yes, Safwan, we can.
Okay. Okay, I think I have to. hope you can still see my screen. Can you hear it too?
Yeah.
And I've worked for other companies before that did not have this option. It was kind of like, sorry, don't know what to tell you, manage your money better. And sometimes that's easier said than done. Money is a huge stressor for me and my family sometimes. So it has improved my concentration to kind of stay on task at work because I'm not worried about the money.
I would recommend PayActive simply because it was simple. It helps with reducing employee stress. It provides a comfortable work environment. So it gives us the edge up.
Now that I have PayActive, it does allow me to de-stress whenever I come to work, not thinking about outside bills. So when I'm here at work, I don't have to worry about anything.
Peace of mind at the end of the day. It's giving me peace of mind that I never really had before. I never had a company that's offered this kind of advance. That they would go out of their way to provide this kind of service. Not every company does. So it's definitely strengthened my relationship with my employer and faith that they would do something like this for me and my coworkers.
And I really couldn't imagine going to another company that didn't have something so convenient. PayActive has helped me because I have less stress going on outside of work. Now that I can use the PayActive and not have overdraft fees and the stress of being a mom because we can't go to the grocery store and get what we need. I don't have to say no to my kids anymore. We can go out to dinner and do things.
This is like the best buddy that I could have. PayActive. I love it.
So with that intro, I'll go to the next slide. So currently in America today, over $200 billion are paid between every year for what is called alternative financial services. And they're paid predominantly by the 70, 80 million people who live paycheck to paycheck. And that, I think, is a big problem. Employees suffer because of that. People who are working lose part of their income. It's as much as 10% of their paycheck, which they lose every pay period, every month, every year, year after year. So this is a big problem. Similarly, employers, almost 20 hours per month are wasted at $15 an hour because employees are distracted, stressing, et cetera, et cetera. So together, these are very large numbers that exist, and PayActive solves that problem by actually working with employers. I remember I was hearing you talk about holistic financial wellness. And I remember when I first called the PayActive platform Holistic Financial Wellness in 2014, people didn't know how to spell it. And they would say, what is this? It's some kind of medicine or whatever. And now I'm so glad that it is becoming something that everyone talks about. So that's the big problem in the US, and PayActive solves this problem, or at least attempts to. My struggle to find a word for financial inclusion in the US has been 7-8 years long. As I've met thousands of people, talked to them, and finally the word I lean on is livelihood. Everyone in the world, and strangely enough in America, the richest country in the world, 2/3 of the population is in a mode of survival. There are three things that create financial wellness: spending management, savings management, and surviving. We are still struggling in the US in helping people survive, and livelihood is essential for wellness to happen. And that is what we think is the way to think about it. So when I say holistic financial wellness, then I have to provide a means for people to have their livelihood last a little longer and so forth. So this is just a screenshot of our app, and we provide a Visa card as well as allow people to take money that they've earned on any other card. It could be a Wells card or whatever, Chime, et cetera, et cetera. We load thousands of different types of cards. So we provide a complete package to manage your spending, to manage your savings, and to also survive, to get money, $100, $200 when you need to buy groceries, et cetera, in a pinch. A lot of people call us the leader in earned wage access. This is a word that I coined about 5-6 years ago. So when you type earned wage access, it comes to my company's website. And I did it very specifically. I oppose the use of early, because early relative to what? This is already earned money. So it's earned. I don't use income because it's wage. Income can be, a commission, a dividend, and so on. And I always call it access, not an advance, because I don't want it to be relative to the fact that advance relative to what? It's already earned money. So I always use earned wage access, and that's perhaps the key point. And when this whole idea was launched, there were many names for it, but I think this earned wage access is kind of stuck. We do partner with the biggest companies of the world: Walmart, FedEx. The last count, I think we had over 4 million people who were eligible to use our service, and we had moved significant amount of money between paychecks. So we give money to the employee after we've calculated how much they've earned. At any point in time, we put up the funds, and then the employer reimburses us on payday. 2020 looks like we will settle about $3 billion or maybe more as the economy is coming back. So we've grown. We've also grown very popular in the sense that I think there are about 8 or 9 companies who are now trying to emulate this idea in England, in America. There are at least 6 companies in Canada, in South Africa, everywhere in the world. But that's what PayActive does. It provides earned wage access and a suite of financial services. We think that's true holistic financial wellness. And if we do that, we really become a livelihood platform. Over and out. Thank you.
Thanks, Safwan. That was great. So let's take one question here. What changes have employers seen in the financial health of their employees once they start using PayActive?
So the 3 metrics that employers track, they are recruitment, retention, and engagement. And the published data that has come from many different independent research, and also data that has come from employers that we work with, but I can't sometimes name them, about between 20%, which was the Harvard Kennedy study, that 20% improvement in turnover, where a single person's replacement cost is about $2,000. So if a company doesn't lose 1,000 people, that's a significant amount of money. So 20% minimum reduction in turnover, and I've seen 30 to 40% reduction in turnover. When it comes to recruitment, which is what we are seeing right now, a lot of businesses are using us as a means to recruit people because they have options. They can take a gig job, they can deliver, they can do those kinds of things. So recruitment is a very big part of it. It's a big part of offering from a company that, hey, come work for me. That's number 2. In engagement, the dividends are absolutely unbelievable, because if you actually treat a human being who's making $15 an hour with a little more compassion, they will be much more productive. And that's easy to find out. Today, there is very little done for the lower income population. Most products are to monetize them. So this actually is a very powerful engagement tool. So these 3 metrics are measured.
That was great. Thanks again, Safwan.
Thank you.
So next, we have Credit Kudos. Leverages open banking so lenders can make better credit decisions.
Hello, everybody. Hopefully you can see my screen share here. I'll take you through a brief presentation on Credit Kudos. First of all, I'm David Fletcher. I'm head of commercial here at Credit Kudos. Thanks for the panelists on the fireside, really engaging chat on financial well-being. And especially a thank you to Ian, who's made my life easier by advocating the use of transactional data in improving credit scoring and credit worthiness decisions. So at Credit Kudos, we have 2 missions. Our first mission is to really unlock lending opportunities within the UK and European economy that have previously been overlooked by utilization of traditional credit scoring. And in combination with that, we have a consumer-facing mission, which is to help consumers access fairer credits with responsible finance that can be afforded. And how we do that is essentially through the utilization of our technology and platforms and insights and products in the financial services community. We're a credit reference agency. We were the first in the UK to combine the use of transactional data or open banking with loan outcome data. So we can better track and understand how someone's relationship with their finances on a day-to-day, week-to-week, month-to-month basis is going to impact their propensity or ability to repay any new financial commitments. Essentially, what we do is we take and manage the consent process of people sharing their transactional data with a financial services institution. And we turn that raw transactional data of people's income and expenditure into data points, insights, scores that enable better and faster decisions. We've worked with a bunch of the biggest clients in the financial services space over the last 5 years, and we've driven significant value in both operational efficiency, reducing defaults, and increasing acceptance rates as well. A few of our main use cases that we sit to achieve very much sit around income verification, how we can very simply improve the process of verifying somebody's income. This is especially important when you look at non-standard income, self-employed, gig economy, zero-hour contracts, all the way through to small to medium enterprises who potentially earn their revenue in slightly different ways, such as dividends or transactional income. We also combine our view of people's expenditure to come up with a really accurate view of affordability. Within the UK market, there's a significant focus from the regulator on making responsible lending decisions through accounting for affordability, making sure that when a decision is made, that person can actually afford to repay that new loan commitment at the end of the next month. We also leverage our insights in loan outcomes to identify and understand risk in transactional data. We've done a lot of analysis and insights into how different transactional behaviors can potentially influence the propensity of someone to repay. Through our technology, we can reduce fraud by understanding the identity of the individual contracting with, and also we're able to monitor the individual as well. So we can start looking at early warning signals that exist to maybe reduce balances or reach out to customers who are having financial difficulties. The technology platform is off the back of the Payment Services Directive that came out in 2018, 2019, wider known in the UK as open banking. We essentially do the grunt work at the front end of connecting to the range of bank accounts and savings accounts and credit cards that exist in the economy. We manage the user experience for consent management, and we also manage all the T's and C's and privacy around that so we can make sure the data is being shared with full customer consent and knowledge. Secondly, we deploy categorization so we can understand exactly an organized view of what that transactional data is trying to say. We utilize machine learning and natural language processing to try and uncover exactly what is being spent on and being earned by that particular individual. And finally, from an enrichment perspective, most of our IP and product and data science is spent on actually how we can uncover new insights and scores within that data to make better and faster decisions. This could be as simple as looking at something like a liquidity score for an individual, where we know what behavior leads up to a liquidity event where somebody cannot afford to repay a new loan. And we can model that on new data that's being contributed so that we can give an understanding to a lender of what are the likelihood of someone remaining positive in their balances. I wanted to share with you a case study we ran with a proof of concept for a major credit card provider. They had a hypothesis, which was that they were overlooking opportunities for lending in the marketplace. They were spending a significant amount of money on marketing to draw people through to their applications and turning those people away through the utilization of traditional credit scores. We tested the hypothesis that transactional data could be used to identify good credit risk customers in that cohort. And after a 6-month process of looking at the transactional data and behaviors, as well as the repayment performance of those customers, we were able to identify to an accuracy of 90% good and bad repayment performance in a previously declined population. Hopefully everyone can understand that not only that is a great business case for an organization to increase their lending, but also helping to serve populations that previously have been overlooked. Thank you very much.
Great, thanks, David. A few questions here. First, what data do you use in order to assess financial health?
Yeah, so we take the transactional data of people's income and expenditure. We aggregate that into a categorized view of their income and expenditure, and then we can create insights and scores on top of that. So from a risk perspective, that could be anything like their propensity and proportionality of gambling or loan repayments that they existing have against their income, all the way through to their income sources that they have, from benefits to pensions income, rental incomes, or PAYE. All of that comes together and we build out a risk scores and affordability scores that our clients can use in their decision making.
Okay, so how about the models on the willingness to pay?
So we have some standardized models across the wider population, but most of our work is really working with clients in their particular populations. So we'll work with people in prime, subprime, motor finance, mortgages, personal loans, each of which will have a slightly different demographic and different population. And what we can do is, once we've deployed the solution, we can learn from the outcomes of the data we're collected to try and build more sophisticated models on those specific demographics.
Perfect. Well, great. Thanks for joining, David.
Thank you.
Next, we have Bankly, digitizes cash for the unbanked in Africa.
Okay, hello everyone. Can you hear me? Hello.
Yes, you're all good.
Okay, awesome. Hi guys, good to have you here. My name is Tomilola and I am presenting Bankly. This is a typical informal market in Nigeria. And the informal market in Nigeria actually accounts for 70% of the nation's GDP. Now, yet, almost 60 million people have no access to financial services. We're talking about people who are in the market, we're talking about farmers, we're talking about people who are in the core of the production economy in Nigeria. And there are many reasons for this. Now, because as usual, when there's a vacuum, something tries to fill it up. This informal sector has tried to fill this gap by themselves using an informal thrift collection system known as Ajo or Esusu. This system is predominant in West Africa. I would say it originated from Cameroon and has spread wide across the region. Now, this system involves a trusted agent, or I'll say in quotes, a trusted agent who goes around at the location of this informal producers and collects daily savings, helping them to digitize cash because their income is daily in cash. So there's no form of inclusion or digitization for them. Now, this agent collects savings daily in cash, ranging from about 30 cents to $1, and helps them to record it in a notebook. Now, also, it's important to note that a lot of women in northern Nigeria and in some locations as well are not culturally allowed to own a bank. So this thrift collection system helps them. Now, the thrift collection system works. However, there are major limitations that's prevented it from scaling or helping the unbanked become truly banked. Now, the first issue is security. Now, when you save with a thrift collector, anything can happen. There have been lots of cases of the thrift collector running away with the money, defrauding them. There's cases of death of the thrift collector, and there's no succession planning to be able to pass on the savings of the saver back to them. The second major issue is access. The customers or the savers are greatly limited by location because the cash savings system and requires a one-on-one interaction with the agent. They are solely dependent on the agent to save and withdraw funds. So if you travel from one state to another, you're visiting a family, or you have need for emergency funds, you are not able to access your funds or your savings at the right time. Now, the last and most important one is data, because these people are unable to, they don't have the identity to actually open a regular bank account. and they don't even have the transaction history or a credit profile to be a credit score to be able to access credit or insurance, they are left out of any kind of working capital access, insurance, or what's not. Now, what does Bankly do? Bankly then use technology to help solve this issue, but how? We took the notebook of the agent and converted it into a wallet system. Now, this agent represents a bit of a bank teller or a bank location in places where the banks have felt it wasn't profitable for them to build a full banking structure. Now, by taking this notebook and converting it into a digital wallet, and also for transparency, we enable the customers to receive SMS to notify them of their savings, and also enable them to track their savings even when they're in 2G locations or they don't have smartphones or even access to data. Now, digital identity, like I mentioned, is one of the major issues of inclusion in Africa. And what are the things that Bankly has done is that the agent also helps to collect primary data of the saver. And then collecting primary data, you're also able to take a picture, if possible, with some of the terminals we have, being able to collect their biometrics and creating an identity for them to be able to to access credit with formal institutions who then find them viable for normal financial services. And I already talked about this transaction history of their consistent savings now serve as a credit history for them to access loans from other financial institutions. Now, within the last 12 months, we launched July 2019, and practically in the last, we then came back into the market in September. In the last 12 months, with half of it being with COVID, we've been able to deploy almost 11,000 locations, being financial locations where people can go to digitize cash. People can also get their identity taken and then able to create a wallet system where they didn't have the opportunity to do so. We've been able to target and digitize for 29,000 customers within the space we're in. We have processed in excess of 22 million transactions within the last 12 months. Now, our business model is very simple. There are three major things that the unbanked wants. We know that first, they want to save without losing funds. So we only help keep the deposit as in a licensed financial bank in a licensed institution, and then help them save money in a way that they are not exposed to the losses or the death of an agent. The second thing is the transaction phase, where the agent or the locations that are bank tellers perform transactions within those locations. And this was pretty helpful, especially during the lockdown, in the core of the lockdown of the pandemic, because most banks were closed. These agent locations within the communities became the point of transactions for this informal sector. And then the team is led by myself, and we have my co-founders who are in technology and products, and generally we've been building and trying to become the unbanked, to bank the unbanked in Nigeria and ultimately across Africa. Thank you.
Thanks, Tomilola. That was great. And so one question that we have here is, how can Bankly partner with other corporations in order to encourage financial inclusion, not only in Africa, but also other countries?
Thank you, Kiswana. That's a great question. So one of the most important things to serve the unbanked is data. Data is needed to to give someone a credit score, like Ian mentioned earlier. Data is needed to price insurance premiums. Data is even needed to give them investment opportunities. Data, where they are, what kind of channels can you reach them, even if you want to give them financial literacy. So what Bankly has done is, by using their mobile phones as a form of information to reach them, we now have the identity and the transaction history of these people. And then we are able, with their consent, of course, be able to open them up to opportunities of credit. We've been able to get inputs for farmers, and this opportunity is what we can work with other institutions, and even scale this. We've been having opportunities whereby people are reaching out to say, we would like to partner with you in Ghana, in Cameroon, and most importantly in South Africa.
Amazing. Well, thank you for joining.
Thank you.
So next, we have Jaspi, who makes sure kids are on the right path to financial literacy and money smarts.
So hello, good morning, everybody. Good afternoon. I'm going to share my screen. Yep. Okay. So can you see my screen?
Yes.
Thank you. So my name is Benny. I'm the CEO and founder of Jaspi. And Jaspi is the mobile app, money mobile app for kids and teens and families. And we're talking a lot about financial inclusions here today. And one of the things that I think people often overlook is that worldwide, and especially here in the United States, kids and teens are maybe the largest portion of the population that are underbanked or underserved. And they need and they require some sort of access to a payment system for them. So we are talking really about two generations, Generation Z and Generation Alpha. Generation Z are freshmen in college right now, the older ones, and the younger ones are, let's say, beginning middle schools, and Generation Alpha are, younger kids than that. There are about 70 million, a little bit more than that, 74 million in Generation Z and about 17 million in Generation Alpha, with 4 million additional kids being born every year. This is US data. Obviously, we're not talking about very small babies, and we're not talking about 18 and 19 and 20-year-olds. So the relevant population for us is roughly around 50 million kids and teens in the United States. And those kids and teens, by all available data, are spending something between $2,500 to $3,000 on a yearly basis on average. So these are substantial amounts of money that are still mostly cash, and they need, a better way to do it. We in Jaspi are connecting three generations. We're connecting kids, we're connecting their parents, and we are also now part of, our assessment or our response to COVID are also connecting grandparents. And the idea is that the adults can give money to the kids for any reason, whatever works for the family. So it starts from allowances, and many families, what they do is they give weekly or monthly allowances, and everything else that the kid does in the house is kind of, because the kid lives there. Some people don't do allowances, but they do chores. So they kind of reward for specific things that kids do, and we support both models. We obviously money for birthdays and for holidays and so on, and for being good in school or excelling at sports or everything really that the adults want. And then the kids can do three things. They can save money, they can do good. We work with a long list of nationwide charities, from American Cancer Society to Girls Who Code and so on and so forth. So the kids can give back to the community, and the kids can spend. And the kids can spend in our in-house Jaspi Mall, where we have a curated long list of products that are available to purchase, and also using our virtual debit card that they can use anywhere that digital payments like Apple Pay or Google Pay are accepted. So the virtual debit card is a cooperation between Jaspi and MasterCard. It's being launched as we speak, so it's being launched these days. And it's not a plastic card, it's not a physical card, it's only virtual. We thought that that's a better answer to our clients because, one, kids lose everything other than their phone, and B, plastic cards are a thing of the past. Probably they won't exist in about 5 years' time. So it's very secure, it's contactless, and it works with Apple Pay. One of the most important things for us in our philosophy, and that I think goes very well with the theme of today, is that we believe that everybody, and is starting at a young age, needs a money plan for life. So we were talking before the panel was about financial literacy. And I think in the Western Hemisphere, but especially here in the United States, we are doing a poor job teaching kids financial literacy. So in most families, we don't talk about money. I think in about 40 or 41 of the 50 states, there are no programs in schools, in public schools, that talk about money or teach about money. And money is almost a taboo. And then, you know, we are raising a generation of kids, and this is not a new phenomenon, by the way. It's going on for about 2 decades now. We're raising generations of kids who don't know what interest is or why it's not a good idea only to pay minimum payments on your credit card once you get that. And one of the things that we strongly believe is that you teach financial literacy by encouraging behavior and by enacting and not by lecturing. So what do I mean? I mean, we create a financial wellness score that is very, very easy for each family to, you know, maintain and help control by doing very simple things. So for example, setting automatic allowance, making sure that you assign the kid a few chores and then the kid would need to complete it. It doesn't have to be 100%, but there is some sort of consistency there. We encourage kids or parents to encourage kids to do real life things like going to the supermarket and buying a loaf of bread or a carton of milk, and so forth. We launched this product about a year ago. We've seen tremendous growth, and it seems that our message really resonates within our population. And I think one of the interesting things is that we are able to do all of this in a very low cost of acquisition per user, both parent and kid. That's it. I see that my time is almost up, so thank you and happy to answer questions.
Thank you. So one question that we have here actually is, you know, what are your thoughts in JASB actually teaching kids how to get involved in investing?
100%. We are working on that. Actually, it's a very good question. We are working on it. The problem, so one, you know, everything that we do is obviously heavily regulated because we're touching money and it's also minors. So the challenge that we have right now, and we're trying to find solution for it, is that a lot of the in the target investment. So our thought is to have investment possible in companies that are household names, right? The Googles, the Facebook, the Apples, Amazon, and so forth. And a lot of times the price per single share of those companies is very, very high. So if a kid has $20 or $50, even $100, it won't be enough. And then you need to buy fractional shares. And fractional shares are a little bit of a headache regulatory-wise, but we are actively working to solve this.
Great. And one more question. How do you actually work with other banks?
So we use a couple of banks, and the way that we utilize them is that whatever money the family wants to give the kid is deposited with those banks in an FDIC insured facility.
Amazing. Well, thanks for joining us, Benny.
Thank you for having me.
So this actually concludes our event today. I hope you had a great time. But before you go, please fill out the poll if you're interested in meeting any of our startups or send us an email. Here's some upcoming webinars to look out for. And any additional questions, feel free to reach out to Nadine. Also, we'd love to hear from you. Please fill out another pop-up survey. And thanks for joining and enjoy the rest of your day.